Now it's time to bring in our next guest, Michael Eastham, founder of Fellowship Financial Group in Altamont Springs, Florida. He's also the author of the book, Common Sense Income Strategies, and a good friend of the income generation. And yes, once again, a very good friend of your host right here. Michael, thanks for joining us once again here on the Income Generation.
It's great to be here, Dave.
Okay, we're talking about international economies. And of course, our whole show today is about how we have the synchronized slowdown globally. And it's being blamed heavily on the U.S.-China trade war. So what do you think? We get this mini deal done by the end of the year like the president's attempting to do. Still isn't signed, sealed, and delivered. We get the mini deal by the end of the year. Does that give us really a chance of fending off a global recession? Or do you think that we're too far beyond the power curve at this point?
Well, I think it could temporarily stave things off. Look, if we have parity between the United States and China, then that gives both sides the opportunity to trade fairly. Up to this point, it certainly hasn't been, and I think the Trump administration has done, at least fighting very hard to try and straighten that parity out. So I think it could certainly push it off for a certain degree, but I think ultimately we're going to see some slowdown, whether that's 2020 or 2021, I just don't know.
Okay. Now, let's say that doesn't happen. The deal doesn't get done. A lot of people are skeptical right now. Some people that are behind President Xi are actually saying, they want more, that's too favorable a deal for the United States. Now, what does that mean? Does that mean next 12 months maybe we're seeing global recession?
Well, you've got skeletons in the closet all over the place. It's just a matter of when are those skeletons gonna drop. I mean, when you look at the United States, I kind of talk about the U.S. as being the cleanest dirty shirt in the laundry basket, and that simply means that we still have our own issues. It's just, just look at the yield curve. I mean, the yield curve itself, historically, when it's inverted, then that tends to lead directly to recession. That hasn't happened so far, and we're certainly dabbling in that environment. So it just really depends. I certainly think that because the economy here is so strong right now, I think that that certainly creates some momentum for continued economic growth and into 2020. But who knows? With the volatile political climate that we're dealing with, especially over the next 12 months, anything could happen.
So what else then, outside the trade war? What other things do you look to globally, not geopolitical per se, but other economic things globally do you look to that really cause you to pause and say, you know what, we are heading off the precipice into some sort of recession coming up, at least in the next 18 months?
Well, manufacturing slowdowns could certainly be a triggering event. Certainly, the consumer spending is going to be a significant event. You start to see significant increases in debt, and we are actually seeing increases in consumer debt right now. So any one of those things, and certainly other things, could make that happen sooner rather than later.
And our economy's doing better than most other economies globally, right, due to consumer spending. But yet a lot of these other economies are actually in negative interest rate environments right now. They've tried so hard to stimulate things, they've got things in the red, and still we're faring a little better than them. So I get that cleanest dirty shirt in the economic hamper thing. We have 45 seconds left in this block. How about the inversion with interest rates between some countries such as Italy that arguably have more risk to their debt, but yet the interest rates on their debt is the same, if not less than ours? It doesn't make sense. The things aren't priced right internationally. Does that scare you at all? And if so, why?
Well, it doesn't make sense, but it hasn't made sense for a long time now. We've looked at that same issue for several years at this point. At first, it was a huge concern to me. It's still a very big concern because you're right. There's no parity economically between countries like that are less stable than we are versus the United States, which is much more stable. So that's a major concern. That tells me that there needs to be a correction at some point. I guess what I've given up doing is trying to, polish the crystal ball and look for the answers. It's just a matter of trying to be prepared and ready for that next step.
Smart man. I love it, Michael. We need to take a quick commercial break. We'll be back in a minute. Stay with us. We'll be back right here on the Income Generation. Just a moment. Now let's bring back in Michael Eastham, founder of Fellowship Financial Group in the Orlando area, right here in Florida. Michael, thanks for sticking around for this last segment.
My pleasure.
The Federal Reserve, what should they do, in your opinion, to give them the best chance of fending off or minimizing any future recession in the next 24 months?
Well, I think they've started doing it. It's been interesting over the last year or so since, really since they did finally realize, hey, we pushed the rates up as high as they can go. Now we have to settle them back down again. I think that was the biggest reason why they actually raised short-term rates to begin with, so that they had a little bit more leverage. I don't think the Fed wants to print more money, but if they continue to push things down too far, they may end up having to do it to maintain some balance in the economy. So I do think we're going to see some reductions in short-term rates over the next 12 months again. But again, I think it was all part of the Fed's strategy to begin with.
So, it's interesting. According to the World Economic Forum, the Fed is less equipped today than it was in 2008 to deal with another recession or another financial crisis. So, in the 1 minute we have left here today on the show, tell our Income Generation members what they can do to best protect themselves in case of another recession.
Well, I think that's a great point. Part of the problem is that the Fed has, the federal government printed $4 trillion worth of money back in the last recession, the big financial correction. So the best thing that people can do to prepare themselves is to make sure that they're being careful with their money, that they're working hard to reallocate their principal and their investments more on the conservative side of the spectrum for income and for reasonable income generation, whether it's interest, dividends, or predictable income streams where you do have some guarantees. So those are the types of things that we're talking to our clients about as they prepare for stepping across the threshold into retirement, or if they're just conservative and concerned about what could happen in the global economy and how it might affect their retirement. Nobody wants to go through 2008 again, so we just want them to be best prepared to do that.
If you want to play the stock market game, it's a choice. It's not mandatory. So, Michael, thanks so much for your time. We really appreciate it.
It's my pleasure.
All right, we'll be right back here in a moment on the Income Generation. I'm David Scranton, and we'll be right back.